Okay, good morning. We are going to finish Chapter 8 today. So we're starting with a question. A bond purchased by Black Squirrel Corporation intends to hold to its maturity in 5 years. So this goes back to what we ended with on Monday. Black Squirrel buys a bond as an investment. Okay, so Black Squirrel buys this investment bond. So now we have to say, okay, it's an investment. An investment is an asset. The bond issuer, so Black Squirrel, let's say Black Squirrel is buying Anheuser-Busch bonds. Anheuser-Busch has the liability. This question is about the investor. So it cannot be a liability. It has to be A or B. So your answer has to be A or B. Now choosing between A or B, the difference between a current asset and a long-term asset is a current asset is anything that is expected to turn into cash within the next 12 months. So when we look at this, Black Squirrel Corp is buying a bond that's going to mature in 5 years. It's going to hold it for 5 years. 5 years, then what that means is they will hold it for more than 12 months. So what you end up with here is that this bond that Black Squirrel Corporation buys is an investment on its balance sheet that's classified as a long-term asset because it's not going to turn into cash within the next 12 months. Okay, so that question will remain open for a couple of minutes until we get to the next one. So before we get into material today, we are using the same handout from Monday. We will go through the entire handout today. Okay, what's due Saturday this week? Chapters 4 and 8. One homework assignment. Practice exam 2 is available. It's due before you take the exam. Okay, now there is no class the week after spring break because we have an exam. I'm not going to be emailing you over spring break. I'll probably email you Sunday night just to say hello after spring break, but I don't want to interfere with your spring break. Now, couple things. Our exam is Monday, March 28th through Wednesday, March 30th. Starts by 4 p.m. This is the week after spring break. Exception. You could take the exam tomorrow. Now, I want to address something that someone said on Monday. Someone said they couldn't believe that I would expect you to know this material and take the exam Thursday. I don't expect anyone to take the exam Thursday. I was offering the exam Thursday as an exception if someone had circumstances that led them to say, I would rather take it Thursday 17th. That is certainly not my expectation that you take the exam this week. This is only for a certain In the past, I've always had 1 or 2 students who will say to me, can I take the exam before? So I wanted to make that available to everyone. My recommendation, absolutely positively, is to take the exam Monday, March 28th through March 30th. So just wanted to clear that up. I'm not expecting anyone to take it tomorrow. It is an opportunity if you have that unique set of circumstances where you want to take it tomorrow. But a couple of people that I've talked to that are taking it tomorrow have been working ahead and preparing for the exam for a couple of weeks now. Okay. Schedule with Dr. Yu. I know a lot of people have been scheduling because I get emails every time you schedule. So I want to address a couple of questions that I got from the end of class on Monday. First of all, the first question, so what I did is I copied the exact wording. So these are not my words. For NSF checks, if someone gives you a check that bounces, how does that change your account? Are you entitled to that money? Okay, so I'm going to talk through this on another slide. So the question again is, for NSF checks, if someone gives you a check that bounces, how does that change your account? Are you entitled to that money? So they're saying, you get an NSF check, what happens? So when you get a check from a customer, so ignoring the NSF part, so a customer pays. What happens when they pay is you would reduce accounts receivable and you increase cash because they gave you a check. So boy, you've got cash, it goes up, you reduce what they owe you. That's so far. So then you take that check to the bank and you deposit it. So if the check bounces and if the bank says this is NSF, the check's no good, what happens next is you have to reduce cash because the bank has charged you for that, and now the customer owes you that because they didn't really pay you. So you need to reinstate what they owe you. So what you end up doing is you reduce cash and you increase accounts receivable. So yes, your customer still does owe you. You have to put that receivable back on the books as well. Oftentimes too, when you get an MSF check in your account, the bank charges you something like $25, which feels really unfair because not only do you not get the check, but you get charged $25. So what companies will do oftentimes is reinstate the amount of the check to the customer's account and charge them the $25 they're getting charged from the bank. So there's that question. Okay, second question. If a company goes out of business, does it still have to issue bonds? Now with this one, again, I copied the wording. I think what the person meant is if the company goes out of business, does it still have to pay back bonds? So that's an interesting question. If a company goes out of business, bonds still have to be paid back. If a company goes out of business, what happens are all its assets are sold off and then the liabilities are paid off, and there's a certain order they do them in. It's all legal about who gets what first. But bonds, and if there's not enough money, bankruptcy court in some circumstances can discharge bonds as well. So you have to pay them back even if you go out of business, but if there's no money, then they don't get paid back. Bond prices reflect this risk. So U.S. Treasury bonds have a lower price than bonds from, say, Blockbuster Video. Okay, a couple of years ago, Blockbuster Video, the interest prices rates on their bonds were really high because there was a risk of bankruptcy. So yes, you have to pay back bonds. Okay, next comment was actually several people said they wanted to go over bonds. Good, because we're doing that today. That's a big part of our day today as we are talking about bonds. We just started with them on Monday, so we're going to finish them up today. So you'll be happy to know. And then the next thing is not particularly a happy thing. The chat room. I got a comment from someone that there was a lot of, in this session, there was a lot of off-topic discussion and people were fairly rude. So I went back and watched this whole thing and watched the chat room, and I would agree there's a lot of off-topic. So I understand there's other things on your mind, but this is a class, and even though it's a chat room, it is still part of the class. So I want to say you need to stay on class topics. If your talk off topic, we're not going to make a big deal of it, but your chat privilege will be taken away. You're not going to be kicked out of the chat room. You can still see everything else, but you're not going to be able to chat. You won't get a warning ahead of time. Your chat will just be disabled. If you have any questions about that, you can feel free to email me. And if you have comments about class structure or rules, that's certainly something you should address with me. You know how to reach me. My email, you also at the end of every class, you have comments, you can get to me, but I can't address it if I don't know about it. And so just keep the things on topic. Do you have anything to add? Okay. Okay. And so I'm sure it'll be fine from now on. But there was a lot of discussion going on that wasn't related to class, so you need to keep it on topic. And again, we're not trying to be mean. We're just trying to keep the class on topic and not distracting. It's not fair to everyone else to have all this other garbage going on in the chat room. So there we go. Okay, so now we're into Chapter 8. Chapter 8 is long-term investments. Again, we're only covering learning objectives 1, 2, and 6. And we have 3 types of investments. This is back to what we were talking about. We're just picking up where we left off on Monday. So trading securities, we're back in Chapter 5. We are doing held-to-maturity securities now, bonds. Bonds have a maturity date. A maturity date says we will pay you back on this date, okay? And so when we were here on Monday, you had the handout that you have, and we were talking about Anheuser-Busch did this $46 billion bond issue, which is significant, second biggest corporate bond issue in history. And they were issuing, in January, they were issuing $46 billion of bonds to fund their acquisition of SAB Miller. Okay, so this is a significant business event where we did this bond issue. So everything in this chapter, we're looking at it from the standpoint of the investor, the person or company to go out and buy the bonds as investments because they want to buy a bond because they want to get interest revenue. Okay, so this is where we were on Monday. I was just saying $46 billion of bonds. There were probably 10 different maturity dates we looked at, and in this example, we're going to look at just 3 of them. So I just picked out 3 of them. So example 4, which we already did Monday, but we're going to go ahead and walk through it briefly here. Purchase 3-year $1,000 AB InBev bonds. This is on page 3 of your handout, okay? So it's in there. It's not the very first page. We had done this one on Monday, but the thing that you need to know on here is on your notes, I didn't write $1,000. All of these bonds we do are $1,000 face value. These are sold in $1,000 increments. So you have the $1,000, the $1,000 face value. So what went on here is I told you the price was 100. Where did I get it? I said the reason it's 100, it's 100%, because the coupon rate equals the market rate. Coupon rate is how much interest this bond pays. That will never change. This bond will always pay 1.9% interest. It pays it semi-annually, so it pays half of it at a time. So it'll pay every 6 months, it'll pay half of 1.9% of the $1,000 face value. The market rate is what the market is paying on the same kind of bond. So in this case, it's a very narrow case, very special case. The market rate is exactly equal to the coupon rate, so we say this bond is selling at par. That's the terminology, par. And when we record this, we're going to debit our investment and credit cash. We're just paying cash for all these investments. That's just implied unless you're told otherwise, but it is cash. So we're paying cash for the investment. And how do we know our price? Our price is 100, which is 100% of the par of the face value, par value. So $1,000. So that was where we were Monday. Okay? Okay. So you need to know the word par, and that's when market rate equals coupon rate. Okay, so now moving on to example 5. Okay, so example 1, these were the 3-year bonds. So now we're moving on to example 5, which these are, I picked out the 30-year bonds for this, and that's not written on your sheet, but it's a 30-year $1,000 bond. Okay, there's a 4.9% coupon rate paid semi-annually. This bond will pay 4.9% interest, half of that every 6 months. That will not change. That is the coupon rate or the stated rate. The next piece of information we're given, the market rate is 4.5. So that's what the market's paying. So when you go out to the market, if you're an investor and you have $1,000, in this case, you have a choice of all the other bonds of the market are paying 4.5%, and the Anheuser-Busch bond is paying 4.9% interest. Okay, so the price, and again, the price, I'm giving you the price quote. Prices are always quoted as a percent of, like a percent of face value. So this is 100. It said it's at 101.25 or 101 1/4. And that's 101.25% of $1,000. So when we do the price on this, this is called a premium. This is called a premium because the market rate is 4.5. Anheuser-Busch is paying more than that. So it is premium. It's more desirable. If you think about things that are at a premium, they're more desirable because their rate is higher. Okay? So things sell at a premium when the market rate is less than coupon rate or coupon rate is greater than the market rate. Premium means it has a more desirable rate than the market rate. Okay? And again, we're looking at it as an investor, so we absolutely want the highest rate. right? We want the 4.9 versus 4.5. So this is at a premium. You need to know the word premium, okay? And so we're comparing that coupon rate of 4.9 to the market rate. So market rate is, we can think of it as what every other bond is paying. So every other bond's paying 4.9%. I would rather receive 4.9%. That's why this is a premium. Okay, so the price paid for the bond will be the face value of the bond, the $1,000. All these bond examples we're doing, the face value is $1,000. So $1,000 times the price that's given to us, 101.25%, 101.25%, so we will have $1,012.50. So the premium, the part extra that we pay, is the price we paid, the $1,012.50 less $1,000 gives us $12.50, and that's the amount of the premium, the extra that the investor pays above the face value. Okay, so when we record this, it's going to be the same journal entry. All of these are going to be the same journal entry to record the purchase. We're going to debit the investment, and we're going to credit cash, and it's for the amount that we paid. So we're taking the purchase price times the percentage. Okay, so that was example 5. That's a premium. Now we're going to move on to example 6, follows that. And now example 6 is a 5-year $1,000 bond. So we're looking at a different issue here, a different bond issue here. This bond, it's a $1,000 bond again, 2.65% coupon rate. That means this bond pays 2.65% annually, half of that for every 6 months. The market rate on the issue date, 3.1%. And again, that's what the market's paying. That's a fact I'm giving you. The price, $99. It's another fact I'm giving you. And this is actually sold at a discount. And the way we know it's a discount is every other bond on the market, when I approach this as an investor, every other bond on the market is paying 3.1%. Okay? So all the other bonds are paying 3.1%. This bond is only paying 2.65%. So you're going to say, as an investor, you don't want to buy this bond because you think, I can get 3.1% from the next identical bond. Why would I take Anheuser-Busch's bond? So what Anheuser-Busch has to do is they have to, in effect, put it on sale, and that's called discount. So Anheuser-Busch will discount it. So Anheuser-Busch sells it for 99% of the face value so that there's a discount to entice you to buy the bond, because otherwise you'll take your money and go out to the market and make more interest. Now, you may wonder why Anheuser-Busch doesn't just pay market rate. And here's the deal. So they start working on these bond issues months in advance before they go to market. This is a big deal. They have to get underwriters, especially, this one's huge. They have several underwriters involved. So they go to the market. They prepare this stuff months in advance. The market rate fluctuates minute to minute. There is no way to predict what that market rate is going to be. So they just have to predict. They also know internally how much cash. They do cash projections over the next 30 years. And this is a big cash outflow for them. They have to pay interest on these bonds, Anheuser-Busch does. So they look at it and they decide how much cash they want to pay. They also know that if they issue a low interest bond, they're not going to get as much for it on the market. So that goes into their decision. There's a lot of decisions on the corporate side, but they have to pick a percentage rate. Bonds have a fixed interest rate, which means they will pay exactly the same thing over the entire life of the bond. So this is a 5-year bond. This bond will pay half of 2.65% every 6 months for the entire 5 years. That will never change. These are fixed rate bonds. Okay, so we said they have to issue this at a discount to entice people to buy their bonds because their interest rate is lower than the market rate. So what we're going to do here, the price paid is the $1,000 face value times 99%. Our discount is the $1,000 minus the $990 paid, $10 discount. This does not seem very significant because you're like, big deal, 10 bucks. But think about this. This is $1,000. This bond issue was $46 billion. And so this is a $1,000 bond. But the number of purchasers of those bonds, $46 billion in bonds, 30 purchasers. That's it. 30 purchasers. So this kind of percentage is huge when you're talking those kind of numbers. So what we're going to do here, again, debit the investment, credit cash. This is really easy. When you purchase a bond investment, you're going to debit the investment, credit cash. That's it for the purchase price. So you take the percentage times the face value. Okay, so far so good. So we've got those three situations. We had example 4 on your note should be at par because the market rate and the coupon rate were the same. Example 5 was at a premium because we had the market rate was less than the coupon rate. This coupon rate was higher, and so we could demand a premium for the bond. And now at this example, this bond is paying less than market, so it has to be issued at a lower price at a discount to entice investors to purchase it. Okay, so we're going to do a question. So, thank you. Okay, so a $1,000 bond has a coupon rate of 5%. The market rate is 8%. The bond will sell for $1,000, more than $1,000, less than $1,000. Okay? So what do you think on this one? Okay, let's reason through this. I've got about 50% of you correct and 50% not correct. Okay, the $1,000 bond has a coupon rate of 5%. So think, put your investor hat on. So you've got $1,000 and you want to invest it. So you look at this bond, and this bond is paying 5%. Okay, so 5%. You look at all the other bonds, and they're paying 8%. Okay? Is this bond desirable to you? Are you going to want to invest in it? Are you going to want to put your $1,000 in an instrument that's paying 5% when you can get 8% elsewhere? Keep in mind, we're assuming that all these, when we talk about the market rate, it's the market rate for an identical risk instrument, an instrument that's the same. So you have $1,000 to invest. If you're going to pay, to have this cost $1,000, the coupon rate on the bonds would have to be exactly $1,000, and very few people have picked A, so it's not A. Okay, so we know that. But when we think about it, if you've got to invest, if you're investing $1,000, and you see under door A, that bond's going to pay you 5%, and door B, the market rate's paying you 8%, you're going to go for the market rate, right? The only thing that's going to get you to buy the 5% bonds, are you going to want to pay more than $1,000 for it? No, that would be completely irrational, right? You want to get to buy this bond, you're going to need a pretty hefty discount, right? That's how you think of this. Do you want to put your $1,000 in a bond that pays 5% when you can go elsewhere to get 8%? No, you're only going to take this bond if you get it at a discount. Because if they sell it to you at a discount, at the end of the bond life, they're going to pay you back the $1,000. So you could pay $900 for this bond, and you're still going to get $1,000 at the end. So, Okay, so I'm going to close this question. I'm going to close the question in about 5 seconds. Last chance. Okay, so yes, of course we would buy. They would have to offer a hefty discount on this thing. They'd have to offer it for significantly lower. You're not going to take your $1,000 and invest it in something paying 5% if the market's paying 8%. You're going to want to go for the highest rate. The only way you will take this bond as an investor is if they offer it to you at a discount, which means they're going to give it to you, sell it to you for less than $1,000. Okay, so then let's try 28, the next question. Okay, so this is the same question with asking for the terminology. A $1,000 bond has a coupon rate of 5%. The market rate is 8%. The bond will sell what? At par, at a premium, or at a discount? This is the same problem we just had, the same question we just had. But now we're talking the terminology. Because we said on the last slide, we said this would sell for less than 1,000, right? This same bond sells for less than 1,000. So if you buy something for less than the face value, okay, is that at par, is that at a premium, or is that discounted or at a discount? Okay, I'm going to close this in 5 seconds. Okay, again, this market rate is way higher than the bond. The only way an investor is going to buy this bond is if you sell it to them for less than the face value. And if it's less than the face value, selling something at less than face value, is that at a premium or at a discount? Okay, last chance, 2 seconds. Okay, and that is at a discount. Okay, so we said that if we have this where we sell it below $1,000, it's at a discount, right? It's something, it's discounted off its face value because it's not as desirable as other bonds. Now, our next one, okay, so now, new scenario. Our $1,000 bond has a coupon rate of 5%, so it's paying 5% interest on it. The market rate is only 2%, okay? So now, every other bond on the market is only paying 2%, but this bond is paying 5%. So this bond, okay, so will this bond sell for $1,000? Will it sell for more than $1,000, or will it sell for less than $1,000? Okay, now, this bond is very desirable, right? So people are going to want it. They're going to want it. And when people want things, they pay more for them, right? Because when things are desirable, that bids the price up. So that's a way to think of how to answer this. This bond is more desirable because it's paying more interest rates in the market. So we would say it's desirable. So I'm going to close the question in 5 seconds or so. Very good responses here, but you've got to get your response in. Okay? Again, very desirable bonds. It's going to be, people are going to want it. And when lots of people want things, the price goes up, up, up. Okay? Okay, final 2 seconds. Okay, this is more than 1,000. You want to make a note that if, make sure that you know this is at a premium. When we sell it for more than 1,000, it's at a premium. The reason it sells at a premium is because it's so desirable, right? Market, everywhere else you go, they're only paying 2%. On this bond, they're paying 5%. It's desirable. It's going to get the price bid up. When it's bid up like that, over 1,000, it is called a premium. Okay, and then one final question for right now before we go on. Same bond, $1,000 bond has a coupon rate of 5%. The market rate is 2%. The bond will sell at what? Same bond we were just talking about, that desirable one that we bid up over $1,000. Okay, going to close it in 5 seconds. Get your answer in. Okay, the bond is selling for more than $1,000. It's very desirable. The market rate is less than the coupon rate. It was just the same bond that we just talked about. Okay, that is at a premium. Okay, so now what we're going to do is we're going to continue with bonds. We have one more small little piece here, and this is that 5-year bond we just had. Okay, so we went through when we purchased a bond. Now we're going to look at interest revenue, and this is a short example, but there's one piece that's a little bit more challenging, but the first piece is not bad. We recognize interest revenue on the 5-year $1,000 bond. Okay, just to refresh, this bond has a 2.65% coupon rate, meaning it pays 2.65% semi-annually, so half of that every 6 months. The price paid for this bond was $99, so 1,000 times 99% is $990. The 99 was a fact given to you. You don't calculate it. And then the discount was the face value less the price paid, $10. Okay, so these were all things that that we talked about. So first thing we need to do, we need to do 2 things. We need to recognize the receipt of the interest on the bond. To calculate the interest on the bond, we take the face value times that 2.65% coupon rate, and then we would divide it in half or multiply by 6/12. They're the same, but the interest is always on bonds, is always semi-annual. So you would take the $1,000 face value times the coupon rate or the stated rate. Sometimes it's just a stated rate, but 2.65% times 6/12, 6 months out of 12 or 1/2, but you get $13.25. So these bonds pay $13.25 every 6 months for this bond. So we're going to have cash coming in, and we're going to recognize interest revenue. Okay, so that's the easy one. That's the one. Okay, we're getting cash. I can see that. Now, the next one, we've got to do one more thing with this bond. This bond was sold at a discount. The reason it was sold at a discount is because the market rate was higher. So Anheuser-Busch went out with its $1,000 bond, and this is paying 2.65%. Maybe the market rate on these kind of bonds on that day was 3% or 3.1. So they had to sell it at a discount because otherwise no one would buy their bond. And so they sold their bond for $990. That was what they sold it for. So at the end of 5 years, Anheuser-Busch has to pay the purchaser back $1,000. So the purchaser bought it for $990, and they're going to get $1,000 at the end. The difference there, that discount, is in effect additional interest for the purchaser. So what we need to do is that $10 difference between what the purchaser paid for the bond and what they're going to get back at the end is going to be spread over the life of the bond as interest. So what we're going to do here is we're going to take that discount. So the discount was $10. We're going to divide it by 60 months. Where did I get 60 months? 60 months is 5 years times 12 months. There's 60 months in 5 years, and this is for 6 months. So basically, this bond is a 5-year bond. We're going to take the $10 and spread it over the 5 years. If we get, and we'll basically, it turns out, if you take $10, divide by 5 years, that's $2 a year. And if you take every 6 months, that's $1. So that's another way to get to it. But you're taking that $10 discount and spreading it over the life of the bond as additional interest to make this bond's interest like the market interest. And that's what's going on here. So we're going to debit the investment in bonds and credit interest revenue for the discount. If we did a premium, it would be the same thing, except premium would reduce interest revenue, so everything would be backwards. We're not going to dwell on the second entry. I just wanted to show you what happens with that discount or with that premium. It's considered an offset of interest, and it's spread over the life. In your book, there's a section on effective interest method. You do not need that. We are not doing the effective interest method. Effective interest method makes the second entry a lot more complicated. We're not doing it at all. Okay, we're just going to use a straight line. This is called amortizing the discount or amortizing the premium. Okay, so what we're going to do next is we're going to do a question. You actually have to do a little bit of math on this one. The $1,000 bond has a coupon rate of 5%. The market rate is 2%. The cash interest to be paid on this bond every 6 months will be what? So I just want to point out a few things. Okay? First of all, the $1,000 bond has a coupon rate of 5%. Okay? Coupon rate is what it pays. And the cash is paid every 6 months. So we have a $1,000 bond. Coupon rate is 5%. The 5% is the whole year, so you would need to divide by 2. Okay, so when you're doing this, when I'm looking here, majority of you have this correct. What you're doing for this one is you will be taking the $1,000 times 5%. So that's $50, right? The $1,000 times $50. But that's for a whole year. So bonds pay interest every 6 months, so they get half of the whole year. So the 5% times 1,000 is 50. $50 divided by 2 is 25. So the interest to be paid every 6 months on this bond is $25. I'm going to close this question in 5 seconds. Should be $25. Okay. Okay, so we're done with bonds. Okay, bonds are instruments that the companies have to pay you back. They have a maturity date, so they're going to pay. Companies are going to pay you interest on a bond, and they're going to pay you back the full amount in 3 years or 5 years or whatever the maturity date is on the bond. You get paid back at the end. Next kind of investment that we look at is investments in available for sale securities. Available for sale securities can include bonds, but a lot of times we talk about stocks. We'll talk about that in a minute. So available for sale securities can be debt securities not held to maturity. So if we buy a bond and we plan to sell it next year, it's available for sale. Or this is also our equity securities. If we buy stock, stock does not pay interest, and stock never gets paid back. So that's why stock doesn't have a maturity date. We initially record these at cost, and then we have to adjust them to current fair value, current market value at the balance sheet date. Okay, so available for sale means, you know, we're not selling it tomorrow, but we could, or it's common stock. So it's available for sale. What we need to do is adjust it to market value at every balance sheet date. Current fair value, same as current market value. It would be the same thing for our purposes. Okay, so trading securities, Chapter 5, held to maturity securities can only be bonds because held to maturity, the only things that have maturity are bonds, but then stocks or bonds can be available for sale. Available for sale simply means we're willing to sell it if the right time comes along. We don't have it planned, but we could. So that's what we're in now. And we are going to be using the handout now. So we are, for the handout, we are on the front page now. We are finally to example 1. Okay. So this is the Harry London Chocolate Factory in North Canton. You might have passed it on 77. And you can do tours there, and they give you free chocolate in the tours. But Harry London and Fannie Mae are owned by 1-800-Flowers. And so 1-800-Flowers, you know, has florist shops, it has the chocolate, it has Cheryl's Cookies, it has a variety of things. Now, what we're going to do now is I want to illustrate stock transactions, okay? And I thought rather than having some unknown stock, I would pick, we're going to do 1-800-Flowers, and there's a reason, which I'll tell you why in a few minutes. And then we're going to do a different company. So what we're doing for this example is we are looking at 1 share of stock, because I think 1 share of stock is easier to understand than having to do a bunch of math. So November 15th, 2015, November 18th, we purchased 1 share. Why November 18th? Because I just picked it out. I was looking at, these are actual real stock prices, so I was looking at a list of stock closing prices, so I picked November 18th. So November 18th, we purchased 1 share of 1-800-Flowers stock, okay? And it was $6.87. So what's going to happen there? So we purchased this 1 share. That's example 1, the very first entry. What we're going to do is we're going to debit investment and credit cash. And it's investment in available for sale securities, hence the abbreviation, but it's an investment, and it's $6.87. We bought 1 share. Okay, so far so good. Makes sense. We have an investment. We gave up cash for it. We always assume we're paying cash unless told otherwise. Typically, you don't buy stocks on credit. Okay. Okay, so investment available for sale. This is a long-term asset. We don't have any plans to sell it in the near future. So long-term asset. Okay, so next up. So that was back November 18th. We purchased our 1 share. So then we come to the end of the year, December 31st. December 31st, if you look at the per share price of 1-800-Flowers, $7.28. Great. Okay, it went up. So when we compare what we paid for it, the $6.87, to the December 31st price of $7.28, it's 41 cents, right? And when we think about, is that a gain or loss? Has that gained or has it lost? You go, well, gee, I bought it for $6.87. It's now worth $7.28. I have a gain of 41 cents, right? But don't call it a gain. We have to put a word in front of it. We haven't sold it. This is at the end of the year. We have to adjust these on our books to market. And when we do that, we still own them. We call that an unrealized gain. Okay? So what we're going to see here, working our way down on the example, is we have to adjust this stock to market. And what we're going to do there is we're going to debit the allowance, okay, and credit our unrealized gain for 41 cents. Okay, so that's all we're doing there is we're saying, boy, that gain came from the change in price from the day we bought it to the financial statement date. Okay, so there was our 41 cents. Okay, we're not done. So now we come along and it comes to, make note, unrealized means not sold yet. That word's going to surface. Surface on the exam, surface all different places. Unrealized means we still own it, okay? Okay, so now back to our calendar. So February 29th, okay? February 29th. The stock market has tanked, by the way, during this whole scenario. February 29th, we saw 1-800-Flowers for $7.81. This is one of the few stocks that has actually grown. Analysts have said that the stock is undervalued and it's doing extremely well. So we sold our share on February 29th for $7.81. So we take $7.81 compared to what we bought it for. So we go back to what we purchased it for back in November, and we have a 94-cent difference. And we ask ourselves, is that a gain or a loss? Well, it's a gain, right? Because we bought it for $6.87, we sold it for $7.81. So that is a gain. It really is truly a gain because we actually sold it, okay? So what we're going to do, we sold that one share. Now, before we can record the sale, we have to do a little bit of housekeeping. Remember this entry that we did back here where we adjusted it because we hadn't sold it yet? We need to take that entry and we need to see this entry. We debited the allowance, credited unrealized gain. So the very first thing we're going to do when we go to sell this is we're going to reverse that. So all we do is we take that intermediate entry, that one in the middle at December 31st, and reverse it. So we're wiping it out. We're canceling it. So we're going to debit our unrealized gain. We're going to credit the allowance. All we're doing is reversing what we did on December 31st. And then after that, we can sell this share of stock. And when we sell it, the easiest way to think of this is we think about how much cash am I getting? I'm getting the $7.81 cash. Okay? I have to take the investment off my book, the original price, which was the $6.87, and then the difference between the two is the gain. Okay? And so we sold this, so we have to first reverse the adjusting entry for the market value, and then we do the sale entry. Okay? Just one share of stock. So if you had invested in 1-800-Flowers, it's going really well. It's one of the bright spots on the horizon. Okay, so what we're going to do before we get to the next example is we're going to do a question, and this one's kind of a thinking question. Okay, so the impact on total assets from a purchase of common stock with cash, what will that do to total assets? Okay, so if we think about this, so let me see, how many people have answered? Got a variety of answers, which is not particularly good. So think about this. When you purchase when you purchase common stock with cash, that is actually the entry on the very top of example 1. So if you look at that entry, example 1, you debited investment. So you increased an asset. An investment is an asset. So you increased an asset. Then you paid for it with cash, which was decrease in asset, right? And entry 1 is exactly what this is saying. So you increased assets in entry 1, you increased assets by $6.87, and you decreased assets by $6.87 at the same time. So when you're looking at this, that's what you're looking at, is your assets will not change if you're simply using cash to buy common stock. You're just shifting one asset to another. Okay, so assets will not change. I'm going to close this in 5 seconds. Okay, so on to our second example. So this is example 2. So we're on that page. Time Warner Inc. This is not Time Warner Cable. This is Time Warner Incorporated. The stock ticker symbol is TMX. This is the Time Warner that owns HBO. It owns Turner. It owns Warner Brothers. Okay, so we're going to go through a stock example with 1 share of Time Warner. I'm going to use the exact same dates as 1-800-Flowers. Okay, so November 18th, we purchased 1 share of stock for $71.77. So first thing we need to do is record that purchase. So all we're doing is debiting our investment, crediting cash. Okay, just like we did before. So we bought the stock. Okay. Next up, though, so it comes in, and we go along, end of year comes, and we've had some bumpy rides with Time Warner, and we're down to $64.67. So we have gone from purchasing for $71.77 down to it being worth $64.67. So the difference between that is $7.10. Now, we look at it, we bought it at 71 something, it's now worth 64 something, so we have a loss. But before we say loss, we still own it, so it's an unrealized loss. So what you're going to do is you're going to have unrealized loss because it has decreased in value. So we're going to debit the unrealized loss. We're going to credit allowance to record. So we're doing that entry again. It's backwards now because it's a loss, not a gain. So we have to do this adjustment. We're adjusting to the current fair value, current market value. Okay, and unrealized, again, means we still own it. Okay, so now we go along and we actually sell the Time Warner stock on February 29th. Now, just background, the stock market has not done well, but it did recover a little bit in this period of time, and now we sell the stock for $66.20. That was the closing share price on February 29th. Okay, so if we go back to what we bought it for, though, we bought it for $71.77. It's now, we sold it for $66.20. So we look at that and we say that's a loss. And that actually is a loss because we sold it. So it's a loss, and it's a loss of $5.57. Okay, because we go back to what we purchased it for. So when we record this, first thing we need to do is reverse that entry from December 31st because we've sold it. We don't have to adjust it to market value. We need to get rid of that entry. So all this is doing is taking the December 31st entry and reversing it out. Next up, we are going to sell the investment. So what we're going to do, we're getting cash. We know how much we sold it for. We sold it for $66.20. We've got to get the investment off our books, so we're going to credit the investment for $71.77. So then the difference between the two is the loss on this investment. So what we did is we went through 2 investments. We went through one that we ended up ultimately selling at a gain, one that we ultimately sold at a loss. Okay. And then we have one more little thing to do with investments, and this is example 3. This is the last part of the handout now, and it's Microsoft. So if we have bonds, like Anheuser-Busch issued bonds, they have to pay interest, and they pay that coupon rate, and we get interest revenue as an investor. When companies issue stock, they pay dividends or not. Companies do not need to pay dividends. I always get a question every semester about what makes a company pay a dividend or not. This is a very complicated question. There's entire courses on dividend theory. In my MBA program, I took a whole semester class on dividend theory. So there's no right or wrong answer. Companies like traditionally utility companies, investors buy utility companies to be an income stock. So they expect a dividend. So utility companies typically pay dividends. Whereas a startup company, they're not going to pay dividends because they need to use the money to grow. So investors will invest in a stock for growth. So as an investor, you have different objectives. You might want growth, you may want income, and companies decide. Well, anyways, Microsoft pays dividends pretty regularly. And let's say you own 100 shares of Microsoft stock. Okay, Microsoft pays a dividend, it declares a dividend, and you receive on March 10th, you receive a 36-cent per share dividend. So the total dividend you get is going to be 100 shares times the 36-cent share, so $36 total. Okay, so what you're going to do as the investor, you're getting cash for $36, and you're crediting dividend revenue because this is income to you. So that's as an investor, you can get interest revenue on bonds, but you get dividend revenue, perhaps, on stocks. So that's the final piece of the investment section learning objective in this chapter. Okay, so now we are going to switch gears to time value of money, which is related to bonds. So when we have these bonds, these very long-term bonds, when we said, oh, this sells at a discount and the selling price is 99, or this sells at a premium and the selling price is 101, there's investors, specifically algorithmic computers set to calculate it, calculate the value of that bond given its interest rate versus the market interest rate. So that number is not just a random number. It's very precisely calculated. And it's calculated based on something known as the time value of money. Okay, so time value of money, principal is the amount that you invested or borrowed, like the Anheuser-Busch, the $1,000 bonds, that's principal. And discounting is the process of calculating what something's worth today. If I have $100 today, that's not the same as getting $100 5 years from now, because money has time value. I can take that $100 today, invest it, and have way more than $100 5 years from now. So we use time value of money concepts to calculate what something's worth right now. What do I have to put in the bank right now to have $100 5 years from now? Or what's that $100 I have 5 years from now worth today? So this is the time value of money. We're only going to scratch a little bit of the surface on this. In your book, okay, there are 4 time value of money tables. You only need 2 of them. So right off the bat, and these tables will be provided to you on the homework and on the exam. If you have any questions that use this, you will have the tables available to you. You cannot use a financial calculator in here because not everyone has one, and that would be silly to require a purchase of a financial calculator for 1 week. So we're using tables, very easy to use. But the tables, there's 2 tables you need to know. Present value of a dollar table, which is this one, and the other one is present value of an annuity of $1. So when you're doing like the homework problem or a test problem and they have a button for present value and future value tables, you click that, you'll have 4 tables available. You only need to worry about the present value tables. You can just remove future value from your choices in your own mind. So that cuts it down by 50%. So which table to use? If you have one sum of money, meaning I'm getting $5,000 5 years from now, what's it worth today? That's one single sum of money. A present value of annuity of $1 table, that's if you have an equal series of payments. Like I'm getting $1,000 every year for the next 5 years. That's an annuity. And an annuity can be a payment or it can be a receipt, but it's the same amount of money every 6 months, every year, something like that. So you have these two tables. Okay, so what we're going to do is we're going to do, I'm going to guide you through it because I need examples to show you. So this is one of those region questions again. So you'll click on where you want to answer and you need to hit submit response. It's one of those questions again. Okay, so here's the deal. I have not sent it out yet. You will receive $1,000 3 years from now. Okay? So you're getting $1,000 3 years from now. Which table will you use to calculate the present value of the $1,000? Okay. So this is one sum of money. Okay? So just click on the okay, now the decision rule, the guidance at the last slide, was to use the present value of a dollar table if it's one sum of money, one amount. Use the present value of annuity table if it's a bunch of the same amount over and over. In our example here, it says you'll receive $1,000 3 years from now. So that is one sum of money. That is only one sum of money. So what you're going to be doing is you're going to use the table that says present value of a dollar. So you need to make sure when you submit your answer that you click in that upper table and that you press submit. Okay? So we're going to close this in 5 seconds. Again, make sure you click in that top table, okay, mark your mark, and hit submit response. This is going to close. Last chance. You cannot type a number or answer. You've got to mark in the table and submit your response. Okay, again, really super last chance, and I've got a couple of people who typed the number 6. It's not right, okay? You've got to mark in the table, press submit. It is closing in 3 seconds. Okay, so the answer is going to be that top table because it's one sum of money, right? Now how you're going to use this, this problem says that it's at 3 years from now. So what you're going to do is you're going to go to the third row. And then you're going to be given an interest rate. In this case, we weren't given an interest rate, but let's assume our interest rate was 7%. So what you're going to do is you're going to go down the 7 column and across to the third row where they intersect to that 0.816. You're going to take that and you're going to multiply by the $1,000. And that's what the present value of that $1,000 is right now, assuming your rate was 7% over 3 years. So if you took 0.816 times $1,000, you would get $816. What that tells you is the present value of getting that $1,000 3 years from now is $816. You could take $816, put it in the bank today, and have $1,000 at the end of 3 years, assuming a 7% annual rate on the money. Okay, so that was one question. So notice that that was one sum of money, so we use the present value of a dollar table. If we have, let's say we're going to get $1,000 every year for 5 years, that would be the present value of an annuity table, and that's the second table. So we're going to do another question. Now this question, you'll receive $1,000 every year for 4 years. So we're getting $1,000 each year. So it's not just one time, but it's multiple times. So again, you need to click on the table, in the table that you would use, and submit your response. Okay, so when we're talking about this one, you will, the question's still open, by the way, so you want to make sure you get your answer in. You're going to receive, you're going to use this present value of an annuity of $1 table, and how you're going to end up doing this is you're going to, and the reason we know that is it's telling us we're getting the payment every year, okay, so for 4 years. So we would say, okay, 4 years, and then let's assume again our interest rate is 7%. So we get down the 7% column to the 4-year row over here, and we get a factor of 3.387. So we take the 3.387 and multiply by the 1,000. So we will get the answer of $3,387. That is the present value of getting $1,000 every year for the next 4 years. If the interest rate is 7%, the present value is that 1,000 times that factor of 3.387. And that's as complicated as we're going to get on that, but that's just kind of like a little introduction to time value of money. Okay, so make sure your answer's in. Again, if you answered this question, the answer is not 3.387. You have to click in the box and submit your response. I'm going to close the question in 5 seconds. Okay, so now that brings us to the end of the chapter. We are done. We're done 5 minutes early. There you go. So I hope you have a nice spring break. I will email you Sunday night after spring break. I will not bother you over spring break. And so we will see you the week after spring break. Have a great, safe spring break.